Hello, and thank you for stopping by our virtual booth. My name is Michael Joseph, and I'm a Vice President and Deputy Chief Investment Officer here at Stansberry Asset Management. I've had the opportunity to speak with several hundred Stansberry Research readers throughout this year, and two questions almost always come up in those conversations. What did we do during the downturn? And how are we positioning clients now for what's ahead? It's my intention to answer those questions in this video presentation. But before we get to the market crash, I think it would be helpful to take a moment to consider where the market was sitting as we entered February, before COVID-19 was declared a pandemic and before the market began to collapse. As we entered February of this year, the US stock market was one of the most expensive stock markets of all time. One of the valuation metrics we like to use is the Shiller cyclically adjusted price to earnings ratio, also known as the CAPE ratio. It measures the stock market's overall price relative to its 10-year real earnings. The chart on this slide shows the historical Shiller CAPE ratio for the S&P 500 up to February. It had reached a multiple of 31 times earnings by then, almost double the mean average. In fact, there's only two other periods that were comparable. One was in 1929, which saw the stock market collapse on Black Tuesday, ushering in the Great Depression. The other coincided with the dot-com bust of the early 2000s. Neither of those periods worked out particularly well for most investors. We all know what happened from there. The COVID-19 pandemic led to massive economic shutdowns all over the world. The stock market went into free fall. The Dow Jones experienced the second largest single-day drop in the history of the US stock market. It surpassed any of the one-day declines during the Great Depression. The VIX, commonly referred to as a fear gauge, eclipsed the all-time high reached during the 2008 financial crisis. When the dust settled, the S&P 500 had dropped about 34% in just 23 trading days. It was an incredibly fast drop. So to answer the first question I mentioned, what did we do during the downturn? We were fortunate to have already been conservatively positioned before the bear market began. Now, it's not as if we could have predicted that we'd be facing a global pandemic and see entire industries grind to a halt. We were already concerned about the market being overvalued. Our portfolios were positioned accordingly, and that certainly worked to benefit our clients. Thankfully, as we grasped the severity of what was happening in the market, we were quick to cut additional risk out of our portfolios early on. So while I can't say that we were making money in March, we certainly think that we preserved capital for our clients compared to what they would likely have experienced in an index fund or with a buy and hold investment advisor that just rides the market up and down. The stock market decline in February and March turned out to be the shortest bear market in US history. And despite all the challenges our country still faces, the S&P 500 and the NASDAQ have gone on to hit all-time highs. We think there's a few reasons behind the historic rally off the bottom in March, but perhaps the best one is the money printing by our central bank, the Federal Reserve. In the first 3 months of the pandemic, the Fed printed $3 trillion, which you can see greatly exceeds the various quantitative easing programs they responded with during the financial crisis. When they print money like this, it's intended to keep interest rates low and encourage investment and spending. Now, importantly, the Fed hasn't stopped. They didn't print $3 trillion and call it quits. They said they plan to keep this up. And so that would argue that stocks may have upside from here. So after a bear market, after global economic shutdowns, after central banks have fired their money bazookas and stocks have had a historic rally, we're back to having an incredibly expensive stock market. It's no wonder that investors are asking, where do we go from here? One of the best known adages of Wall Street is don't fight the Fed. We don't intend to. At the same time, if you're like us, you aren't thrilled at the idea of pouring all your money into stocks with the hope that this unprecedented level of money printing continues to prop up equities. While there's no silver bullet to combat all the unique challenges that lie ahead of us, we do have a number of principles that have helped us decide how to invest during these challenging times. And to finish this presentation, I'll share some of those with you now. The first principle is to focus on what doesn't change. A great example of that is gold. Businesses come and go, but gold has had a track record going back thousands of years. It's always been a stalwart hedge during uncertain times. There's still plenty of uncertainty and fear out there today. And when you combine that with negative real interest rates and the potential for the Fed to devalue our currency with all the money printing they're doing, we believe this may be the best setup for gold that many of us will ever see. The second principle is to look for trophy assets. Porter described trophy asset investing as buying the Hope Diamond at cubic zirconia prices. The Hope Diamond part relates to these trophy asset companies owning truly one-of-a-kind type of assets. They don't often go for cubic zirconia prices, but when we have a big market drop like in March and everything sells off, it can be a good time to hunt for them. Finding less correlated opportunities. A good example of that would be merger arbitrage investing, which refers to investing in the stock of a company that's the target of an announced acquisition. Now, there's typically a difference between what the target company trades for and the ultimate acquisition price. In a successful merger arbitrage investment, the investor pockets this spread as income when the deal closes. This is an area we often favor to get a return for our clients that isn't dependent on whatever the stock market happens to be doing any given week or month. Skate to where the puck will be, not where it is. This is an often repeated quote from Wayne Gretzky. As an example of this principle, there isn't a lot of worry about inflation right now. That's not where the puck is. But with the Fed printing money the way it is, we think it could absolutely be where the puck is going. How do we get in front of it? One way is to buy hard assets like residential real estate. And to be clear, we're not referring to REITs. We very much favor owning actual physical property, and that's something we've enabled our clients to do through private investing partnerships. We'll wrap up with preserving optionality. Said differently, we believe in having dry powder in the form of cash or short-dated treasuries. If you're a believer in Warren Buffett's advice of being fearful when others are greedy and greedy when others are fearful, we think the best way to accomplish that is to be in a position to buy when everyone else has already sold. This is a fast-moving market, and whether you're looking for a money manager today or not, if you see some value in keeping informed about our best thinking and how we're investing, please do get in touch. We usually have a report or a webinar every month or so, and if you're not already getting invitations to access that material, you can give us a call or send us a brief note, and we'll make sure you're able to access that information. Thanks for joining us, and enjoy the rest of the conference.